They've said they're looking at this. Can you give us a sense of how aggressive you think a look they are giving it?
Well, knowing certainly the New York office as I do, if they're the ones involved or if Washington is involved, my guess is they're all over it. I think the problem here is that a lot of the conventional theories for enforcement actions, trading suspensions, things of that nature may or may not exist here. But for example, is there coordinated trading going on where there are agreements among traders? Those are the kinds of issues that the SEC is going to be looking at.
Right. Where do you think is the bar at this point, given these new technologies and these new social practices, of what a violation of securities laws is? Is it any different now than it was in past cycles?
No, really not. In a lot of ways, you can analyze this as a bubble. It's a micro bubble in the sense that it's limited to a handful of stocks, but it's essentially a bubble. And it's people speculating that the price is going to go up. And, that's obviously very dangerous. But from the SEC's point of view, there are really two ways to pursue it from an enforcement perspective. One is you'd have to look to see if there's manipulation. And manipulation is really a term of art that the Supreme Court defined 40 or 50 years ago. And it really means rigged trades. So in other words, you'd have to have coordinated trading where the back and forth results in no risk to the people who are driving up the price. And at least from what I've seen in the news, there does not yet appear to be evidence of that. The other conventional approach would be to look for misrepresentations or misinformation in the market. So for example, if the person giving the rallying cry here is actually selling a stockpile of stock while telling everybody he's buying the stock, well, that would bring you into a more conventional securities fraud type analysis. But absent either that kind of misrepresentation or evidence of a manipulation, it's a difficult area for the enforcement division to deal with.
Yeah. I'm curious, Andrew, we were talking about it at the top of the show, but an ETF like the SLV, the silver ETF, has a lot more flexibility to issue more shares more quickly when it sees a jump in price, like what we've been seeing today and really in the last couple of days. Standalone stocks don't necessarily have that same ability to issue and sell more shares as quickly. Is that something that the SEC should consider making possible when you do see just the huge spikes that we've seen in names like AMC and GameStop recently? I would imagine that would help with some of the volatility.
Yeah, but you've always got to be careful about issuing emergency orders. Back in the last financial crisis, there was the short selling ban, which was very short-lived because it had very adverse collateral consequences. And so the problem with moving too swiftly is that there are going to be a lot of unintended consequences. And so while proposals along those lines may well be something worth looking at, I think they need to be given both careful consideration, but also opportunities for public comment so that the SEC doesn't inadvertently do more harm than good.
Shepard Smith here. Thanks for watching CNBC on YouTube.